That's one way to make a gift. Donor-advised funds and private foundations are, in essence, charitable entities themselves that you can contribute to.
Welcome back to Quarter Over Quarter. I'm Don Drury, your host, president of Moran Wealth Management, and I'm joined by my co-host, sidekick, Tom Moran, CEO, CIO, and founder.
Good morning, Don.
Hey, I'm glad you're here.
I'm glad I'm here also.
We're talking about something today that I know is near and dear to your heart. So I'm going to try to refrain from chiming in. This is really, we probably don't even need our expert today, but we brought Mike Mongin. Mike, thanks for joining us.
Thank you.
Mike is an attorney and an advisor with our firm. And today we're talking about philanthropy, donor-advised funds, charitable foundations, all of those things that encompass philanthropy and planning. Tom, you've done a lot of this personally.
But also with consulting with Mike, so I think he's a valuable resource to have here.
Without a doubt. All $12 of mine, I'd like to know, Mike, if I should consider a foundation. So we'll chat after this.
Sounds good.
Perfect. So, Mike, talk to us a little bit about what the different types of charitable entities are available to individuals, because I know there are a lot of different ways to achieve a goal of philanthropy. And I also, and I hope we can get into, you don't always need to be uberly philanthropic for these to make sense.
Absolutely. I kind of break these things down into actual charitable entities that you're giving to and what we would call split interest entities, where a charity is going to be a beneficiary, but also some non-charitable beneficiary also. Charitable entities, obviously, I'm sure people have given money to church or to their schools or to some health organization, American Heart Association, Red Cross, anything of that nature. And they give cash to them and they're getting a charitable deduction. If under the tax laws as they stand today, it's, it generates deductible items in excess of their standard deduction. That's one way to make a gift. Donor-advised funds and private foundations are, in essence, charitable entities themselves that you can contribute to. They are entities that you have a modicum of control over with regard to a donor-advised fund and complete control over with regard to a private foundation. But the entities themselves are charitable entities that when you make gifts to them, you get a charitable deduction for it, as well as obviously giving money to a charitable entity to achieve its philanthropic mission. When we talk about the split interest ideas, we're talking about trusts. And when we're talking about trusts, we're talking about trusts having interests for beneficiaries, income beneficiaries, and then remainder beneficiaries when the trust is over. And those trusts generally people most talk about are charitable remainder trusts and charitable lead trusts. The idea being that there's a non-charitable beneficiary that is going to receive something from that trust, whether it's an income interest, as it is with a charitable remainder trust, or a remainder interest as it relates to a charitable lead trust. The charity is the opposite in each of those. In the charitable remainder trust, obviously, the charity is the remainderman of that trust and gets a benefit. The charitable lead trust, the charity is getting an income stream from that trust for a period of time. And what's left in the trust when the trust term is over goes to the non-charitable beneficiaries, typically your family.
I've always had the philosophy that people have to have some charitable intent. This is not a tax strategy alone.
Absolutely.
I think, again, it doesn't have, they can be more charitable because of the tax benefits, but I think they have to have some organization that they've helped in the past near to their heart that they want to benefit. I don't offer this as just a way to, if you've never been charitable, here's a way to save some taxes.
Exactly. that is probably the penultimate question that I ask a client, even before we talk about charity. Part of my discovery questions with a new client is I ask about whether they have any charitable inclinations. And if they do, then you explore them. But when you start talking about these strategies are win-win for the charity and for the client, both with the charity's mission being a win for both the charity and the person who is inclined to benefit that charity. The tax benefit can be also a priority, but it's never going to be the benefit you thought it would be if you were going to do this for tax purposes first. You'll ultimately be dissatisfied or unsatisfied with the result if it's for the tax benefits that you're hoping for. But it can be rather, if you structure them properly, can be rather tax efficient for clients when they have a situation that warrants it.
Sure. I know that my wife and I, probably a decade or probably maybe 15 years ago, started a donor advised fund. Mm-hmm. And it's been a great vehicle for us. When does an individual look at, okay, I've done a donor advised fund, but is there a continuum? And at some point you look and you say, there's something that might be more optimal for that solution.
Sure. So a donor advised fund is different from a private foundation in that you ultimately don't have control over the assets that you contribute to the donor advised fund. It's essentially a sub-account of some larger public charity's public foundation. Mm-hmm. And major custodians have it with Fidelity and Schwab, but even community foundations have donor advised accounts that you can make contributions to. The control that you have is that once you make a contribution to it, that's your charitable donation, but then you give them advice, donor advised fund, as to where you want those dollars to be distributed. Oftentimes, the organization providing the donor advised fund has limits. What do we need to open an account for you? It may be $5,000, $10,000, $25,000. It just depends on who you're dealing with. But I've opened small donor advised funds years ago when I didn't have any money, with $5,000 with Fidelity. Opened another donor advised fund in memory of my father, with a little bit more money than that, with contributions from his friends. And so these sound somewhat sophisticated and maybe unfamiliar, but you can grasp and understand them rather quickly and understand how they work and how they benefit both your charity and also yourself for meeting those goals.
Is there a crossover where people should start with a donor advised fund and then maybe say a foundation, especially if you want to get your kids involved on the board for philanthropy and good stewardship? Is there a crossover point, or people have both? I mean, what are your thoughts?
People do both. I've actually done strategies where we've done a charitable main trust, a charitable lead trust, a donor advised fund, and a private foundation. And the combination of all those things was a result of the initial charitable inclination of the client, but then an understanding of wanting to provide some benefits now, an understanding of wanting to control a large component that for future gifting, low basis public stock that was concentrated in their portfolio, and from an investment perspective, we were looking to diversify. It became a great source to fund either of these funds. And then from a tax perspective, the understanding of the limitations that you can that are subject to gifts to these various entities, whether it be a foundation or a donor advised fund or these trusts. And so a combination of these things, both with appreciated stock and maybe with some cash and some other things, allowed us to put all these four things together that became effectively their philanthropic plan. Yeah, I think in that case, that was a client well over $50 million in net worth. Mm-hmm. But it really, the idea of each of these things is good for anybody at any level. And then the combination of them becomes something that you craft as an advisor with the client as you understand what they're trying to achieve immediately and in the future with whatever level control that they're looking for.
I would think a donor advised fund, Don's $12 would qualify, but I think a foundation you should be looking for fairly larger amounts because there's a cost to setting those up.
Absolutely,
and annual accounting fees and legal fees. So
yeah, I kind of simplify it a little bit for clients. I often call a donor advised fund a rent a foundation. You basically open an account,
right,
and someone else is handling all of the back office
sure,
stuff that's required to be compliant with the IRS, and you get all the benefits of giving the money away and some other things.
There's fees involved. I mean,
yeah, it's fees involved, but it's a product solution, a simple way to get it. That when you talk about a foundation, you're essentially setting up a nonprofit, and you have to file returns and a number of other steps need to be taken to comply with all of the IRS requirements of a nonprofit. And oftentimes, those foundations elect to hire a foundation administrator, which is costly. But so in your case, in my career, I think when I started, I think I used $5 million as the gift, as the threshold for a foundation to justify the cost and the hassle and all the other things.
Yeah,
I think it's now at least 10.
I think that's probably a good starting point.
One of the things that was attractive to me as it related to a donor advised fund, but I think it's applicable across all of those, is, and you hearkened on this, the ability to donate highly appreciated securities that you now don't have to pay a capital gain on, and the ability to prepay future donations. So you get that deduction or you get that tax benefit year one, but then you can dole the funds out over an extended period of time to whomever. And I think that's a great aspect of that for a lot of people because they think, gee, I don't want to give $1 million or $5 million today, but I'd love the benefit of doing so.
There are minimums you have to make each year.
Sure.
With regard to a foundation, 5% of the corpus at the end of the year needs to go out. But with a donor advised fund, you don't have those limitations. You don't have those requirements. As a donor advised fund holder, the public foundation has to make sure that they're doing everything they're supposed to do. But you have hundreds, maybe thousands of account holders under that public foundation don't have those requirements, which makes it an easier solution.
There's no minimum requirement distribution for
from a donor advised fund, correct? And then essentially again, it's kind of the dip your toe in the water as into a more sophisticated charitable step for a charitable inclination. When you say grown beyond giving a $10 gift to the Girl Scouts or a $100 gift to the church or what, the types of things you're going to be making more significant gifts. Having the donor advised fund as a clearinghouse to do that is a great place. And like you said, what I've done with some clients who are getting into this is say, look at their tax returns and I see you make $10,000 a year in charitables over the last several years. How long have you been doing that? And he said, I've been doing a little bit and it's just growing the last probably 5 to 10 years. It's been between $5,000 and $10,000, and it's going to be at least $10,000 going forward. And we're at the top of the market, and they have a concentrated position in NVIDIA. And we want to diversify a little bit. And I say to them, what are your thoughts of funding your charitable gifts at $10,000 a year for the next 10 years right now? And he said, well, how do I do that? And I said, well, you can put $100,000 in a donor advised fund and then kick out your $10,000 annually. You get a deduction of $100,000 now. You won't get it and you make the gifts in the future from that donor foundation, but you get that $100,000 now. And the client says, that's great. I'll write a check. And I said, wait a second. You've got NVIDIA stock with really low basis. We could probably move $100,000 of NVIDIA into that donor advised fund. They sell it. You don't pay the capital gains tax on it, and you get a deduction for $100,000 against your ordinary income. How does that sound? Well, I know you want to diversify my portfolio, and this sounds like a good idea. So we've done that over and over and over.
So
now there are different amounts different amounts to deduct between a donor advised fund and a foundation. The amount of deduction you get may vary,
and that's related to your adjusted gross income. So when you're going giving appreciated public stock to a donor advised fund. It's up to 30% of your adjusted gross income. When you're doing to a private foundation, it's only 20%. So you do have those thresholds. So always keeping that in mind in terms of where clients' AGI is to figure out. And even if you do exceed it, you do have a carryover of charitable gifts that you weren't able to take that you may have given in excess of those limits to future years. It is limited to 5 years of that carryover, but I've done this with several clients here, and we've eaten up that carryover in the next several years afterward, not even approaching that 5 years. So
Good.
Well, I was just going to say, if you were going to sell that NVIDIA and then pay the capital gains tax, you're essentially being able to supercharge your gift and actually give more than you otherwise would have given had you written a check.
absolutely.
I'd like to talk about something that I've talked with so many clients about and seems to be a really compelling aspect behind a private foundation. And that is, you may, as the matriarch and patriarch, have certain values, and you want to, it has become increasingly difficult to instill those values of philanthropy and giving in future generations. So involving your children, involving your grandchildren in the thought process of who are we going to give funds to this year. I had one family that used to do a family summit, and we'd talk, and I would go, and we would talk about all things around the family, aside from the foundation. But then we get into the foundation, and they had the children and grandchildren do a little due diligence, and everyone would bring a charity that they were passionate about. They would talk about that. And, that's a great way to instill that value that the family has in future generations.
Yeah, absolutely. I've had a number of families where we've done that. We've actually had these annual family meetings, bringing everybody in from other towns, and basically a weekend, and we're talking about the estate. And one of the things was, the value of charitability being passed down from generation to generation, and bringing this to young children, teenagers, middle schoolers, high schoolers, and giving them autonomy to spend a year finding a mission or a cause that they really liked, putting together a presentation to the family. And when I put the agenda together for this particular family, I had it at the end. It was kind of like the last thing we did before we left. And Grandpa said, no, we're doing this first. I want them up first, and they're going to be, and they said, when they're done, they can do a tour of anything else around the town, but I want this first. And so it ended up being the first thing that we did. In fact, at the dinner the night before, he would steal their thunder and start asking them questions about what they were looking into and everything else. And then, Grandpa, I got the presentation for tomorrow. You're taking all the good stuff. So that was an interesting family that came to me and said, we got everything we need. We want to give back. And I remember him saying to me, he says, I'm spending the rest of my life, my job is now giving away money. And I thought, that's an interesting philosophy that he says, but I'm not going to do it. It's going to be my family doing it together.
And those are such fun clients to work for. I think because our philanthropy, we've met other people who are philanthropic, and they're just a wonderful group of people that have been blessed in life financially, and they want to give back. And it's definitely some of my favorite clients. What about charitable remainder trust? We used to do a lot more of those. Is the donor advised fund or the foundations replace that, or do you take the time for?
Well, I don't think it replaced that, because remember, the charitable remainder trust is one of those split interest charitable versus the donor advised one being the charities. Often you can make these entities the beneficiary of these split interest trusts. I think the charitable remainder trust as a entity is attractive to people who are charitably inclined when they have appreciated stock that they know they need to diversify and don't want to pay taxes on. And so by funding a charitable remainder trust with appreciated stock, the income stream from that charitable remainder trust coming back to the non-charitable beneficiary, whether it's a grantor or a grantor's family, okay, they're going to get an income stream that's taxable to them. But by putting that appreciated stock in the charitable remainder trust, they get a deduction, just like they were putting it into a donor advised fund, but they're getting an income stream back.
Right.
And that income stream is taxable. And the way that income stream is taxed is worst to first, meaning that ordinary income is the first thing those assets generates during the year. That's going to be part of that contribution. But all of that appreciated stock, appreciation that the stock, upon the charity selling the stock when it received it, is held as capital gain, and that basically funds the rest of that income. So it's taxed as capital gain income to the beneficiary, but over a period of time while they're getting the income stream. So they're not avoiding the capital gain, but they're deferring and delaying the payout out of it. And that's obviously very beneficial because you're delaying a tax that you know is flat. It's going to be 20% or lower. And so that is a very effective way to fund these charitable remainder trusts. And ultimately, when the term ends, the charity gets what's left in the trust and achieves that goal in the future. So it fits well for clients who are like, I need an income stream in retirement. I'm charitably inclined, but not right now, or at least these assets don't have to go right now. And it'll be a nice thing to go when I die.
No, they're not taxed on the internal, they're taxed on the part of the distribution, right?
They're taxed on so when the trust generates income,
Right.
ordinary income will automatically be attached to whatever got distributed from the trust.
Right.
And to the extent that doesn't eat up the entire annuity payment back to the grantor, what's left will be first capital gains,
right.
until that's eaten up, and then it's worst to first the way out. Ordinary income, then dividends, and so on and so forth in terms of tax rates.
And we haven't mentioned, and I've like my clients, some of them are very older, and they're in the qualified distribution phase, RMD phase. And I first mentioned if they have if their distribution RMDs are 100,000 or more than 100. That use some of that up to $100,000 as a part of their RMD as a deduction. So
the way that works is you have, first of all, a beneficiary of an owner of an IRA has to be at least 70 and a half years old
right.
to qualify. The limit, I believe, for 25 is now $108,000.
Oh, they've raised, okay.
And what they do is if you send that $108,000 of your RMD directly to a charitable entity.
It can be more than one too.
And exactly, up to 108 to a bunch of charitable directly from your IRA to that. Can't come to you, can't go anywhere, it has to go directly there. That is not reportable on your income as income. So it's above the line. It's not even a deduction. It's basically just not included at all. So that's ordinary income that you otherwise have to pay tax on. So it's a great way to fund, again, a gift to a charity with pre-tax dollars that would otherwise be taxed at ordinary income if you took it. And so, the QCD, Qualified Charitable Deduction, is a very useful and effective way for a charitably inclined person who has the means, the fiscal means to do so, and it doesn't need the RMD for their living, to effectively give a very tax efficient gift away.
And it could be part of, let's say you look at their tax return, they're doing $20,000 a charity. It could be it could be $20,000. Doesn't have to be 108.
Sure, exactly. That's the max of what you can do.
Right. Yeah.
And get the benefit of it. Right?
Exactly.
So, Mike, let's bring this home, and I'm going to ask you one question. And I know you hate these, and that's part of the reason why I do it is just to needle you. As our listeners and viewers are thinking about their charitable giving this year, how can they be more intentional and tax efficient in that gifting? What's the thought process and the algorithm they need to go through?
The first step, as Tom mentioned at the very beginning of this episode, is your charitable inclination and coming to terms with that and how much you feel you can contribute and give back within your own fiscal means. Once you've taken care of that idea, then you go and you check out all these different options. And it's kind of driven by your circumstances. Whether you're a client who may be in retirement but has a standard deduction that is going to be far greater than their itemized deductions, and a charitable gift is not going to be in the neighborhood of $30 or $40 or $50,000, but maybe 10. In which case, but they're also receiving RMDs. They might be saying, well, I can use my QCD to do that gift. For the person who has the concentrated stock position, who's charitably inclined and has been itemizing their deductions, but they're itemizing their deductions, but it's not near that QCD threshold, but they can increase their deductions by being able to afford to transfer more assets. Then you give away the appreciated assets like the NVIDIA transfer to a donor advised fund or something of that nature. So I think it's driven by your vision for what you want to have happen, and then let your advisor identify the various strategies for your consideration. And as we talked about with one of my other clients, we incorporated all four together and that was a year in particular we had to do that because his income number was going to be so high because he sold his business.
Sure.
So we had to get it done that year.
I want to add one other thing. Our loyalty is to our clients, and it doesn't happen often, but there are clients that are honestly so generous with both charities and their children that we want to make sure they don't overgift, that they don't put themselves in a situation where they've been very generous and they're very, very philanthropic or supportive of their children, but we want to make sure that they're taken care of too.
And that's where what we do with clients is walk them through a clear financial plan and build this into that plan to ensure that they are going to have a successful
We usually
retirement.
accomplish both, but we just don't want to make sure that they feel they're not doing everything they've earned and deserve in their later years, that because they've been overly generous.
That's a great point to end on.
Thank you.
We hope you've enjoyed this, given you some ideas on how to incorporate thoughts around your philanthropy, your gifting, whether it be to your church or other charities that are near and dear to you, ways to maintain that family value through generations. We'll have links down below if you'd love to have more conversation or think through it with an advisor. We'd be happy to sit down, talk with you, walk you through this process, and help think through it. We'll see you on a future edition of Quarter Over Quarter. Thanks.
Thank you.